Hey guys, sorry I couldn't be there tonight, but hopefully this works out okay and you guys can hear me well. So I'm Joe, and I'm here to tell you a little bit about consumer staples and some of the stocks we want to buy to put in the portfolio. So without further ado, sector overview. The consumer staples industry, it's the companies we all know, the companies that we're used to seeing. We have them in our house, we see them in the grocery store. It's the Walmarts, the Johnson & Johnsons, the Coke, the Pepsi, CVS. It's direct-to-consumer products, and it's the essentials for life. It's toothpaste, toilet paper, shampoo, all this stuff that you don't really think about purchasing. It's also based a lot on brand loyalty. For example, Oreos versus another cookie. You're going to stick with the brands you know, the brands you like, and the necessities. Typically, the sector does better when the interest rate is low during a recession type environment because they provide steady growth and a healthy dividend. So right now, it's not the attractive industry to get into, but it will help balance our portfolio and provide stable and viable companies to help diversify. The sector is subdivided within 16 subcategories. Think of it about the beverage industry. You got the alcohol industry. You got sports drinks, coffee, tea, water. So all the categories are kind of subdivided into those lower levels. But I'm trying to pick good undervalued companies that hit all those markets to help diversify the portfolio. Quick glance to how the sector has performed compared to the S&P 500. You can see it more towards the recession is actually outperforming this S&P 500, but it's lagged it for the last 5 years. And then the last year or two, it's really kind of trailed, but that's because it's not the tech companies, it's not the Apples, the Teslas, the companies that have really skyrocketed. The more healthy consumer goods that provide a healthy dividend and decent growth. Here's just a look at some of the major weightings in the XLP fund. You'll see all the companies, I'm sure you recognize them all: Coca-Cola, Pepsi, Walmart, Costco, CVS, Walgreens. So these are the primarily weighting of the top 15, the main cost drivers of the sector. So after looking at all those sectors, here's the companies that I looked at and that I think we should put into the portfolio. Constellation Brands, Kraft Heinz Company, CVS, Estee Lauder, and then for the developed markets requirement, I think we should add British American Tobacco, Diego, and then for emerging markets, I actually found Walmart, Mexico, and Central America. So that I think will help diversify into the Latin America market for the portfolio. There are some concerns with this sector. Typically, our Bloomberg challenge is only going to be 3 months, and typically it's not a short-term investment ideal stock. You don't normally want to do energy or tech, but these still could perform over the 3 months and provide a healthy growth to help support our dividend yield, our portfolio yield. It's much harder for these stocks now typically because they don't work as a bond substitute, so it's not the ideal the return, the 40-50% growth you're going to see maybe like you would on others. But now that the rates going up, investors are going to be moving back into the bond market. I think some of these companies have felt that, and they're a little undervalued now, which makes it a perfect time to buy them. The first company I looked at was Kraft Heinz Company. As you can see in the ticker here, there's been a bit of a dip at the end of 2017, and I think it's a good time to buy. It's a quality company, has strong financials, core brands. Everyone knows Kraft, Kool-Aid, Capri Sun, Oscar Mayer's, Weight Watchers, Smart Ones, so planners. It's all the core products that consumers know and enjoy. So there's been an expectation that they're going to have a lot of organic growth through their core staples that they're making healthier. For example, Kraft Mac and Cheese, they're going to provide a healthier options for families and little kids, as well as adults. And as well as Capri Sun, less sugar. So that's kind of the organic growth that the company's going to see. They've also had a huge corporate savings initiative that they've saved almost $2 billion in expenditures. So that's a plus, as well as the sales. They're benefiting from last year. They had a huge investment in facilities and equipment. So in 2018, we expect to see that profit realized. FactSet, this was a good sign. 12 out of 17 analysts recommend a buy, 5 hold, and 0 sell. So the other investors are high on this stock as well. It's the third largest food and beverage company in North America, fifth in the world, and Berkshire Hathaway, that's what you see this spike here. They bought 27%. Warren Buffett invested in the company to help partner and help the merger of Kraft and Heinz. Next company, CVS. Again, CVS has the theme of being undervalued. You see, has kind of performed this with the S&P, and then it kind of dipped recently based on the news of the merger with Aetna. But still, I think that means the timing's good to buy. It has quality financials, strong PE ratio, good free cash flow per share. And obviously the merger with Aetna, that's supposed to be realized in the second half of 2018. So I think buying now would be a good time before that takes off, because I think a lot of investor optimism will increase as the deal gets closer. So in the next couple months we can ride, that build up to the merger by buying them. FactSet, another strong indicator. We had 19 out of 25 analysts recommend a buy, 6 holds and 0 sells. So CVS is really, they could offer a lot of competitive advantages by combining the insurer and the retailer for purchasing power and just various synergies. And with the time like Amazon is coming in to be a competitor, it's great for them to help keep our competition at bay and grow the company. Constellation Brands, this one, as you can see, has just done very well over the last 5 years. It's a quality growth company. I think it helps provide a nice, stable, diversified company for a portfolio. Again, strong PE ratio and free cash flow to share. It's a leading producer of wine. Primarily, I'm sure you've all heard of these companies: Robert Mondavi, Ravenswood, Arbor Mist, Corona, Modelo, and Ballast Point. So it's more of a wine mix with some craft beer. 80% of their wine harvest was complete before the wildfires hit in California this year, unlike other wineries. So I think they're poised. Well, other wineries lost more than during the wildfires, so I think they're poised to do very well this quarter because they still have majority of all their products still good, still be able to hit the shelves. And due to the supply being down, I think that'll drive demand prices up. Again, company has initiatives to go with profit into double digits. They currently are around 8-9%, but they just did a $5 billion share repurchase program in cost containment, as well as to diversify, because everyone's worried about the alcohol industry going down. They just purchased 10% stake in Canopy Growth Corp, a Canadian cannabis company that offers medical and recreational marijuana for consumers to stay ahead of trends. So I know certain states, they're seeing alcohol decline with marijuana is being legalized, but this is to help offsuit that. Again, 15 buys, 5 holds, 0 sells. Estee Lauder, another company to diversify, makeup, quality company, growth, you'll see. Strong financials. The revenue has been growing at 14% on a quarterly year-over-year basis. And they're the 14th and 4th straight. It's the 14th and 4th straight quarter of earnings and sales beating respectively. The superb quarter also encouraged managers to perk its outlook. Again, FactSet has strong recommendations: 16 buys, 6 holds, and 0 sells. British American Tobacco, again, diversification. This is more to diversify across the world. Again, undervalued. It's had a dip as of recent. Again, strong financials. Largest tobacco and alternative tobacco company, and bought a 58% stake in Reynolds American. International growth in the Middle East and Asia Pacific, which is very rare that a tobacco company is actually growing, but in those regions they're doing very well. And they are expected to profit of more synergies and cost cutting and purchasing power with Reynolds. So a lot of benefits there. Another strong FactSet recommendation: 12 buys, 3 holds, and 0 sells. So I think this would be great for the portfolio to diversify. Diego, this is a niche market company. What I like about this one is you can see they've done very well as of recent. A little bit of a decline, but I think they're going to stay that positive. Again, growth-oriented niche spirits. They pretty much only have the quality core spirit hard liquor brands that people enjoy. Strong financials, and they actually had some great growth in India and China last year as they get more into that market. They're getting some of the market share for the premium liquor. The board issued a 1.5 British pounds buyback, so that's huge, and they increased the dividend. So those are both really strong signs for the company. They just bought Casamigos. That's the George Clooney liquor that sold for a lot of money. They're buying a lot of stuff. They're a premium company. FactSet 6 buys, 15 holds, 2 sells. But I think it would be a nice niche market for a developed nation. Walmart for Mexico and Central America. This was the emerging market requirement. Again, diversify to South and Latin America. 19% PE of 19.4. Free cash flow of 2.7. The sign I liked about this one was they just opened 79 stores and price clubs in Mexico in 2017. Retail exposure in emerging market, and they've had 6 straight years of continued growth or the equivalent profit number. So they've been very strong. And again, FactSet 3 buys and 8 holds. So in summary, I'm looking for undervalued companies which are expected to correct in the next few months. I picked companies that I think would provide stable earnings and a good mix into our portfolio going forward in the semester. And the companies in the developed and emerging markets, I think, really will help diversify out of the North American market. Tried doing that as quick as I could to be in the 10-minute requirement, and hope everyone has a good night. Thanks.